Now the ratio chart is showing that we're right at that inflection point where a big divergence is due to occur. Hello, everybody. My name is True Demon, and I am the Devil's Stockbroker. In this video, I'm going to be covering the current market conditions and helping you figure out exactly where we're going to be heading in the next coming weeks of the market here on February the 2nd. Happy Groundhog's Day, everybody. So first things first, on the surface, we have the stock market heat map, which shows a lot of green everywhere, but this is extremely misleading because today was a big earnings day. And unfortunately, the story of what happened after the closing bell is very different than what this stock market map shows. Right away, let's take a look at the SPY and try to observe what exactly is happening in the market. So, for the last couple of weeks, we've actually seen the SPY ripping up through the top of its megaphone pattern. So, essentially, this megaphone has been believed to have been broken. One of the big pushes from mainstream media, especially in finance news, was that a reversal was pending because of essentially FOMC showing a big reversal in the way that the Fed is going to be handling interest rates. The Fed interest rate, while we have expected a big slowdown over the next several months while we wait for the cause and effect of all these rate hikes over the past year to take effect and truly show what the reaction is going to be from the market and finance um, in terms of what that's going to do to interest rates and actual fiscal performance in the economy. This isn't the thing that's going to truly affect the market now. Now we are experiencing a big event known as earnings compression, which is something that we talked about a few quarters ago. I think as early as the second quarter of 2022, when the earnings for a lot of these big companies on the SPY were doing extremely well at first, but ever since the third quarter have slumped big time. So, looking at the SPY, there are these four major touch points that occurred on this megaphone pattern. I'll actually circle these. One, two, three, four are the major ones. And then we had this big breakout candle that closed down back inside the megaphone and started this essentially what looked like a big cup formation. You could say cup and handle, inverse head and shoulders. It looks differently depending on how you look at it. But it more or less to me looks like a pretty clear cup and handle where we had a big breakout that saw us breaking through all these areas of resistance. Now, on its face, that's a great opportunity for the bulls. However, fundamentally speaking, the entire economy is still in this big lagging phase. Right now, inflation is still not really been reined in. We're still experiencing 6.5% inflation right now, which doesn't feel like a lot when you hear that number. And I owe that to the fact that inflation is a misleading topic. But the way that I think about it in order to simplify things is if you were to think about inflation back what it was back in 2021 when it was around 2.5%, then if you think about how long it would take for inflation to have an effect on your money, it would actually take, at a rate of 2.5%, it would take 28 years for your money's value to be slashed in half, right? So 2.5%, it takes 28 years for you to lose half of your money's value. It's buying power, so to speak. But at the rate that we're going now, we actually are experiencing 6.5% inflation. So how does that change the math? In just 10.5 years, your money loses half its value. That's a big difference with just such a short, with just such a small increment in the amount of inflation. And that's the power of compounding. So that effect is now being felt in the economy because although inflation reached a really scary number, breaking out past 8% in 2022, what's happening now is that the inflation is sticking and it's holding its place. And we've seen this kind of like slowdown in the way that inflation's been declining. So this is just a quick glimpse at the U.S. inflation rate year-over-year chart, which shows the massive spike that we experienced all the way starting in 2021, where we rose all the way from, it was actually close to 1.5% all the way up to that really terrifying 9% number. Now we're seeing a decline back to 6.5% according to this chart. Now, there's some debate about the accuracy of this, but for our purposes, it doesn't really matter. What we're most concerned about is, can we get this to decline back to these safe levels below 2.5%? Anywhere in this zone is considered to be safe, stable inflation. Again, that's subject to debate, but that's what the world considers to be natural, stable, and that's what the Fed's target rate is. So, depending on how fast we can get back down to that point, is what's going to determine how the economy responds. Back to looking at what the SPY is doing right now, that inflation has punished a lot of companies. And despite the SPY moving up at this trajectory, there's some fundamental things to be extremely careful and, in fact, a bit fearful of. Because right now, where the SPY currently is, it's just basically been ripping upward nonstop ever since we had the dividend date at the end of December for the SPY, and all of the expectations for a big turnaround now that the Fed has basically said that we're going to slow down rate hike raises um, for the duration of the next 2 quarters of 2023, and they're going to kind of have a wait and see strategy to see how these rate hikes affect the economy. There is a big waiting game being played here, and now we're being really cautious, waiting to see what the effect of that is. And now the market interpreted that in the most positive light that it possibly could have, and it made me really nervous, and I kind of just stayed away from this market because it seemed really unpredictable and unsafe to me. But as you can see, things just have been moving up nonstop. There's a couple of things that I find to be a bit of a problem, though, and that is starting with this giant Elliott wave pattern. We've had these lows and highs back to back, and we just broke a new high again. But one thing that we have yet to do is break through this resistance that was sitting back here in July. We're actually precisely at this point where we were back in July of 2022, where the market was fighting to break through a significant point of resistance that was in the form of its daily 200 period exponential moving average. And it wasn't until the market had hit the 200 daily simple moving average on the 16th of August that we saw a big pullback. And that came in the form of Apple uh, losing a lot of value in its equity, and other big companies like Amazon, Microsoft, Google, all posting some pretty poor expectations for future earnings reports. And that basically started the cascading domino effect of things just falling apart, and the market started to collapse really quickly. What I think is about to happen is the same exact thing, except now rather than the companies saying that we're expecting things to be a little bit poorer than usual and giving that guidance, now we're actually going to start seeing the effect in their earnings. And if you take one look at Apple on its chart after hours, you can easily see the effect of this. Apple posted a pretty bad negative surprise, dropping 3% of EPS uh, below expectations, and their revenue was more than 3.5% under target. Both of these effects we can imagine came partially due to the interruption in their supply chain and the loss of their Chinese factory due to riots that were going on overseas that were producing the iPhone, and that came at a critical point in the early winter months that were most critical for Apple to get their supply of iPhones for sale during the Christmas season. And because that supply chain interruption happened all throughout those periods, I was I was fully expecting Apple to post an awful earnings because of that, because I knew that that would interrupt their ability to supply all of their stores with a fresh, flush supply of iPhones to sell to consumers. Whether or not the consumer was there with interest to buy wasn't even a question. I'm sure that there were plenty of consumers that were interested buyers, but lack of availability across the entire United States and even globally, if you wanted to stretch it out that far, it just wasn't there. The availability of their product was gone. And because that lack of availability creates other problems for the consumers, such as being put on wait lists and having to decide, oh, well, if it's that expensive and it's that hard to get, I might as well just like go try a different type of phone or buy an aftermarket, used product. And people started being forced to make those choices. And now Apple's earnings have reflected that that terrible timing of the loss of that factory. Amazon is another one, and their earnings were a little bit better in terms of their revenue. They actually beat their target by 2.5%, so well above target. But the expenses for Amazon, due to further supply chain issues, that just it brought down their bottom line significantly, and they had a loss of 14 cents per share, which was a pretty devastating blow, since their target was expected to be quite positive. The current situation with Amazon, in my mind, is that Amazon is struggling from the retail end, and that's reflecting the lack of confidence by the consumer. This is the Michigan Consumer Confidence Index, which we just recently had an update from the month of January. This is produced by the University of Michigan. And the Consumer Confidence Index kind of just is a gauge of how the general consumer is feeling about the state of the market and their ability to make ends meet, how the economy is running, whether staples are affordable, and things like that. And things started to get a little bit better after hitting their absolute worst point in the summer of 2022. Now, this is a bit deceptive because right now the media was pushing this huge narrative of like things are finally going to get better. The Fed is reducing its position of rate hike changes, and things are suddenly going to get a whole lot better. And of course, the consumer confidence index gets a big boost. What I want to show you, however, is if I go ahead and overlay the SPY, and we take a look at the SPY, we see that we've had this really awful market, and then all of a sudden we had this big surge that occurred from October all the way through December, January, and we've had the market kind of like flattening out and bottoming out, right? And that's exactly what everybody figured was going to happen. Now let's actually go back and look at 2008, this little area of the chart right here. If you look at when the Consumer Confidence Index, which at the time in June of '08 was at its absolute worst, everybody was feeling the absolute worst about the economy. There was this bump that occurred throughout the summer months and the fall months of 2008 at that time because the housing crisis was kind of like they kind of halted it, right? Uh, at that time, the subprime crash was at the worst of it, and then all of a sudden, talks of you know bailout situations hadn't been brought up yet because the state of the banks wasn't fully realized. But the government was looking to kind of help out the consumer and save everybody from what was perceived as like really bad money management and throwing blame on individuals, just blaming the poor as they tend to do. Well, the consumer confidence index had this big jump that occurred in those 2 months. It just took 2 months. And even though the market only barely recovered, it was enough that it brought some confidence to the average consumer because they felt like assistance was coming for them and the economy didn't crash quite yet in the way that was expected. The housing market was in absolute devastation at that point, but the average consumer was managing to hold themselves up and people were surviving. And that held up the consumer confidence index until suddenly everything crashed again because that was in September when the last when the other shoe dropped and everybody realized that the banks were out of money. Then then all hell broke loose. And that's the fear that we're now facing for the rest of the stock market, because everybody is now just at that point where we're pivoting in our realization between, oh, they said things were going to get better, but now we're at that point where we're actually waiting to see whether or not they do. And we're only just a few weeks away from utter disappointment. And then just one last analysis for the market. I wanted to show the SPY versus the high yield grade bonds market. So over here at the very top, we have a ratio chart of these. This kind of just it divides the two charts from each other. This blue and yellow one is for the high yield grade bonds, and then this is the SPY by itself. Now, when we look at these when we look at these three charts, one thing that you begin to notice is that the HYG has this, the HYG over SPY has this declining set of highs. And that really has not changed. The SPY has broken out of its megaphone pattern, and even the high yield grade bonds have done pretty much the same, uh, breaking out slightly. But now we are printing what is known as an abandoned baby candle after a big gap up in the market. So junk bonds had this big jump but failed to break out of any kind of resistance. And you see this on the SPY also. So the SPY actually ran into resistance right here, and high yield grade bonds ran into resistance at this point as well. And now the ratio chart is showing that we're right at that inflection point where a big divergence is due to occur. And that's precisely what I am expecting out of this next move in the market, because what I see in this chart is a pattern repeating itself where the market gets overly exuberant about conditions that have yet to actually manifest themselves in the economy. And that's the essential things that we need to see for us to believe that the economy is improving is declining prices of staples, gasoline, oil, energy, and um, and for there to be a shift in back into consumer discretionary spending. None of that's actually happening. And what's worse is that now we still have this housing market crash that's still ongoing, okay? That hasn't changed. You want to take a look at a really terrifying chart. This is a chart of the existing home sales in the United States, okay? This is a chart that shows that, so if a home was already pre-built, meaning existing, and isn't being newly built by a housing manufacturer, construction company, etc., these are the rate of homes being sold on the open market. So in the pandemic, we had this massive jump of people just selling off all their existing homes and transacting all these existing properties, right? And this amount of home sales was steady throughout the entire pandemic. Ever since April, we saw the initial decline where all of this started to, collapse. And that's because the desire for existing homes is now pretty much um, gone. Anybody that's in their home anybody that is in their home that they bought during the pandemic is either going to settle down and make sure that they're going to stay in it, or the more likely scenario is they overpaid for the house and now the equity value of their homes is going to start to go into decline as this housing crash uh, proceeds. New home sales have declined just as badly. We actually saw a big push in the last quarter of 2022 because all these new home manufacturers were shoving all of their homes out onto the market in a hurry to try and get them off of their books. But there was a huge problem with that. With all the new home sales just kind of falling off of a cliff, and in the desperation of these home builders to get those off of their books, they've cut a lot of corners, and it's caused a huge amount of problems in the real estate industry. Not even just with the home builders themselves, but also the REIT investment companies that invested in those businesses. So that is yet another domino that is preparing to fall. So we've covered a lot, and This video is getting a little long at this point, but I just wanted to put this out in front of everybody that we we have already seen the SPY overextend itself past a very significant area of resistance. It's broken through two already that were a little bit beyond my estimates, but at this time, I'm feeling a little bit more confident every day that we are nearing a short-term top. And my feelings that a spring crash is still in the works. I don't feel at all that this rally at all disproves my thesis at this time. So my suggestion, not financial advice, would be to very carefully keep an eye out on the existing setup. We've seen the RSI moving up and up on the daily, and we see the MACD pushing lower highs. So if we are looking for confirmation of another cross down, we've only just gotten a short-term cross down and cross back up with this last move here on the ABC wave that I pointed out earlier in this video. And now there is a possibility for rejection here very soon. So if we see the price turn around on the SPY, basically at any time this week, if it's not going to continue moving on this rate of ascent and breaking this previous high here from back in August of last year, then that essentially leaves us only one direction left to go, and that would be straight back down, at the very least to retest the top of this megaphone. And if we break that, then really the only support that we have is all the way back down at 375, and then below that, 350. So there's a long way to fall in a very short amount of time. And if that is indeed the case, then we should expect to see some severe panic in the market in the near term. That's going to be it for this video. I want to thank you guys for watching. If you guys, whether you agree with me or disagree, I want to hear your own thoughts. Give me your thesis in the comments below. If you liked the video and you found this useful, please be sure to leave the video a like. Helps out the YouTube algorithm and gets this information to more people who need it. And if you guys are interested in learning more about the markets yourself, feel free to look us up. Our website is hellstradingfloor.com, where you can sign up to our Discord at discord.gg/hellstradingfloor. Thank you guys again for watching, and I will see you in the next one. But until then, have a hell of a time in the markets.